Good morning, everybody, and welcome to the Siler Wealth Management video blog. Today is Tuesday, December 22nd, and that's right, 3 days away from Christmas. We hope everybody is not so frazzled. I know you're driving around this area. It looks like everybody is frazzled, and please don't text and drive, okay? I'm getting really annoyed with that. Anyway, let's talk about what's been going on in the market lately. A couple of things. We've had a little rough going the last couple of days since the rate hike. The rate hike is a positive thing. It gives you reassurance that the Federal Reserve Board believes that our economy is growing well enough that we can start going to more normalization. And zero interest rates is not normal. So they're starting to go that direction. But there are two ways the Fed can raise rates. There's the fast cycle of raising rates, and there's the slow cycle of raising rates. Now, the fast cycle would occur, you have about 8 Fed meetings, FOMC, which is Federal Open Market Committee meetings next year. About 8 of them, I believe. Fast cycle would be that they raise every one. They're raising a quarter, and then we'd be up really quickly and be at a much higher rate by the end of next year. A slow cycle would be every other meeting or so. The likelihood is the Fed is not going to raise rates at their next meeting, but they would probably the meeting after that. That gives that prediction of there are probably 3 to 4 more rate hikes next year. So let me tell you what happens during a fast rising rate cycle where the Fed raises every meeting. Historically, the market has gone down 2.7% after the Fed starts raising the rates in that cycle. So you would think that from now to the next year, after they raise every meeting, the market's down 2.7%. Now, that has happened many times throughout our years, and one of them I remember was particularly nasty. It was 1994. I remember looking at 1994 and the market absolutely getting bludgeoned early in the year, but then it rebounded end of the year where it actually traded flat, much like this past year, although we didn't get the rate hikes this year, but the market is down and bonds are down, but hasn't done anything at all. I mean, you have a few rallies, but mostly it's been on the defensive. Now, that is what happens after a fast rate cycle. Market's down about 2.7%. In a slow rate cycle, I'm going to get the exact number, but the market is up a year later, up 10.8%. So if they take their time, and they've used the word gradual, and I know everybody looks at their thesaurus when they read the Fed minutes, and they kind of want to digest everything they said and dissect it and see what words they use. But the bottom line is, it appears that our economy can handle gradual, slow cycle rate hikes. 3 or 4 next year puts the Fed funds rate at about 1 to 1.25%, probably, maybe 1.25, 1.5, somewhere around there. Right now, the prime rate is 3.5, puts the prime lending rate at 4.5. Your mortgages are going to be about 5.5 by the end of next year. Okay, that is still based on history, not for you spoiled people that refied your house at 3.125%, because that refi game is going to be over. It's going to be hard to lower your rates from where they are right now. In fact, I made this prediction: we will never see rates this low again in our lifetimes, meaning my lifetime, because I'm pretty old. Okay, so in a slow rate cycle, the market's gone up 10.8%. Keeping in mind that this is an election year, and the last 9 out of 11 election years, 2016, the market has gone up 9 out of 11 years. Now, all that said, when you look at it percentages wise or as an odds maker, chances are the market's going to be higher next year. And I know there's a lot of pessimism out there in stocks, and I believe that we are going to have a good year. I believe that in our situation, my money management, Siler Wealth Management, I believe we can have a good year. And the reason is, I think what makes your whole financial life critical is asset allocation. You can't just own the plain vanilla mutual funds anymore. You just can't. You have to be more targeted, more specific. There is a hub and a spoke approach. You have your hub stocks that you have here, which are all the plain vanilla mutual funds, but you really need to spoke out. You need to find those sectors that are going to outperform. Because if you just keep buying the S&P 500, you're only going to do what the S&P 500 does. You're never going to outperform. You're never going to get what they call any alpha in your portfolio. Alpha is the ability to outperform your benchmark, which would be the S&P 500 in this case. All right. So asset allocation is critical. Clients, I know a lot of clients watch this. you've seen it in your portfolio the last few weeks. We've made some changes, and we are being more overweighted in financials because those do well. Floating rate does well. There's non-correlated assets that do extremely well. I mean, we love this nursing home REIT, but that's gone. There's no more. It closed to new investors, but a lot of our clients got involved and had, great. It was a great opportunity. So, that being said, we are no longer taking any appointments for this week. Of course, you have Christmas coming in a couple of days, but not tomorrow. We are booked for the rest of the day and tomorrow. Next week, it's really going to be on a case-by-case basis. If you want to sit down before the new year, which makes sense, to go over your portfolio. And I have an email went out, or my newsletter, you could probably find it on the website right now. It's 16 financial New Year's resolutions. Check it out. It's pretty interesting. It's basic things that everybody should think about. One of them is looking at your portfolio and trying to look at the reallocations, maxing out your 401ks or your IRAs. There's a lot of different things. Budgeting. There's really basic things that sometimes, with all the hustle and bustle of life, you kind of forget about. Okay. So if you have any questions, you can email me, message me, call my office. I'm sure you know how to get a hold of us by now. We can do a few appointments next week, but then we're really going to focus on after the first of the year. And it's no better time to look at your portfolio and see where it is, including your annuities, because those are probably not performing at all. And your 401ks need to be reallocated because things change. And your IRAs, your trusts, and your individual type accounts, so brokerage accounts. So feel free to contact us. I'm Lee Seiler, Seiler Wealth Management. If you have any questions, please feel free to, and I will actually, if you have a question, I will answer it on the air. So this way, everybody, I'm sure there's a lot of questions like that out there. All right, everybody have a great holiday. I'm not going to be back on the air till after that, but have a great and safe holiday, and I'll see you next week.